The US housing market is basically frozen solid right now. Nobody is moving. Yet, somehow, Home Depot is funding the single biggest strategic pivot in its entire history. Right now, existing home turnover is stuck at a measly 3%. That is a historic low, and we've been stubbornly sitting there for 4 straight years. People are locked into their current mortgages, and they're just not budging. But despite that deep freeze, Home Depot just took on a staggering $52.8 billion in total debt. They are using this massive war chest to fuel a highly contrarian acquisition spree in a market that, quite frankly, looks completely stalled out. So you've got to ask, why on earth would they bet over $50 billion on a market that isn't moving? Well, the real story and the massive upside potential is hiding just under the surface. In this explainer, we're going to break down the evidence behind this massive bet, the execution risks, and the specific operational triggers that could unlock a major valuation shift. To understand this massive pivot, we really need to look at the engine of their business. When most of us think of Home Depot, we picture the DIY consumer, right? Homeowners tackling weekend paint jobs or fixing a leaky sink. But there's a second, wildly more lucrative customer out there, the professional contractor. General contractors, roofers, specialty tradespeople, that is where the real money is. And that brings us to the real target. By acquiring companies like SRS Distribution for over $18 billion and Mingledorff's, Home Depot is aggressively expanding its total addressable market to a mind-blowing $1.2 trillion. They're moving way beyond standard retail aisles and pushing directly into specialty building materials and a highly fragmented $100 billion commercial heating and cooling market. The crazy part of this equation is the revenue split. Normally, DIY and pro contribute equally, a 50-50 split of the company's baseline revenue. But those pros, they represent an estimated $700 billion of that new addressable spend we just talked about. Locking down this pro market isn't just a growth play, it is Home Depot's ultimate economic moat against digital-only competitors. And that moat is incredibly structural. Think about it. Home Depot already commands about 52% of the U.S. home improvement retail sector. They basically run a virtual duopoly with Lowe's, controlling over 80% of nationwide hardware sales. If a contractor wants to leave Home Depot, they have to walk away from the quote center bidding system, their custom trade credit, and a massive fleet of 16,000 delivery assets that can drop materials at a job site in 3 hours flat. The switching costs are absolutely massive. But here's the bear case, and it is the market's central concern right now. Because the housing market is totally gridlocked by high interest rates, there's an estimated $50 billion in deferred home improvement spending. Homeowners don't want to trade up or start massive discretionary renovations. So the big fear? The fear is that Home Depot is building this giant, expensive distribution machine for projects that simply are not happening. Let's look at the hard evidence. On August 18, 2026, Home Depot reported their Q2 fiscal 2026 results. And honestly, they delivered a really solid beat in a tough environment. Net sales hit $47.86 billion. That's a 5.7% increase year over year. Adjusted earnings per share came in at $4.92, which beat analyst expectations of $4.73. And company-wide comparable store sales actually turned positive, rising 1.7%. That represents a $2.6 billion incremental gain in sales compared to last year. And guess what drove it? That pro segment we just talked about, totally outpacing DIY demand. But management is staying pretty cautious. Even with the strong quarter, they chose not to raise their full-year guidance, projecting comparable sales growth to stay somewhere between flat and 2% for the year. Why? Because of that structurally slow housing market. But if you dig a little deeper, there's a hidden nuance in these earnings. During the quarter, Home Depot snagged a massive $730 million federal tariff refund. This directly lowered their costs and gave them a near 1.5% boost to their gross margin. This critical cash injection totally offset higher logistics costs and the lower margin mix from their recent acquisitions. And hey, by the way, if you like deep evidence-based stock breakdowns like this, make sure you're subscribed. Taking a step back to look at the overall business quality, the qualitative scorecard gives Home Depot a weighted blended score of 7.8 out of 10. Their market dominance and profitability are absolutely top tier, scoring 9 out of 10 thanks to best-in-class operating margins and an unbeatable physical footprint. But look at financial health and growth outlook. They're both sitting at a 6 out of 10. Growth is a bit capped right now because their retail footprint is largely saturated, and that financial health score is definitely feeling the weight of all that elevated leverage. All of the research behind this explainer, was created using Flash by StockSentinel.ai. You can generate deep research reports like this one for any public company in the world, completely free at flash.stocksentinel.ai. The core company research is free. If you want an ongoing investing edge, Flash has a premium feature called Best Ideas Now. Every week, it surfaces the highest conviction ideas across 3 investor styles: long-term compounders, hidden gems, and dividend hunters. You also get Portfolio Watch, which monitors your portfolio and flags important changes, and Insider IQ, which tracks meaningful insider buying activity worldwide. You'll see a QR code in the bottom right of this video. Scan it to download the Flash app and try it yourself, or access Flash on the web at flash.stocksentinel.ai. Pricing is going up over time, but once you lock in your subscription, your price never increases. Okay, pivoting back to that 6 out of 10 financial health score, let's look at the actual balance sheet risks. At the end of Q2 2026, Home Depot reported just over $2 billion in cash. But check out the debt. Between short-term obligations, current installments, and long-term debt, they are carrying over $52.8 billion. That heavy load has forced management to hit the pause button on their historical share repurchases, which in the past has been a massive driver of their earnings per share growth. And all that debt creates some very concrete execution risks. Merging over $23 billion of acquisitions, specifically SRS and GMS, into one cohesive digital and physical platform is incredibly complex. Plus, this is all happening during a major leadership shift. On August 12, 2026, CEO Ted Decker went on temporary medical leave. Now, strong executives have stepped in to run day-to-day operations, but any delays in his return could slow down corporate decision-making right when they're in the middle of executing this massive pro-realignment. So how do we value the company given all these moving parts? This is a hypothetical framework for thinking about possible outcomes. It is not a prediction, and it is not financial advice. The stock could go much higher or much lower than any of these scenarios. We're looking at a 5-year model ending in early fiscal 2031, anchoring to the August 18, 2026 closing price of $337.88. We're applying a 60% probability to our base case, a 20% probability to a high case, and a 20% probability to a low case. Let's break down the operational assumptions driving each of these outcomes. In the low case, with that 20% probability, we assume mortgage rates stay high and housing turnover stays totally depressed. Integration issues drag net profit margins down to 7.5%, and revenue grows at an annualized rate of just 1.5% to hit $184.2 billion. Valued at a lower 17 times price to earnings multiple, this pretty much crushes the upside. But contrast that with our 60% probability base case. Here, we assume the housing market gradually normalizes, starting in late 2027. That finally unlocks all that deferred spend, letting revenue grow at an annualized 4% rate to $208 billion. Integration synergies push net margins up to 8.5%, and as they return to moderate share buybacks, the valuation multiple bumps up to 21 times earnings. Then we have the high case, our final 20% probability. For this to happen, we need a sharp drop in mortgage rates, sparking an accelerated housing recovery. This new specialty distribution platform captures explosive pro cross-selling, driving net margins up to 9%. Revenue rockets to $234.3 billion. With strong cash flow, aggressive share buybacks resume, and the market rewards this massive growth with a premium 24 times earnings multiple, delivering a massive 13.1% annualized growth. When you run the math on these implied future share prices, the low case drops the stock to roughly $236. The base case pushes it up to nearly $402, and the high case, that rockets all the way up to $576. If we apply our probability weights across these scenarios, we land on a weighted target of $403.60. That implies a 19.5% capital appreciation potential from current baseline levels. Bringing this all together, here are the 3 absolute most vital takeaways. Number 1, winning the pro wallet is the true catalyst here. Successfully integrating SRS and Mingledorff's is exactly how they defend their moat. Number 2, there is $50 billion in deferred home improvement spending sitting in this frozen housing market, just waiting for a catalyst to thaw. And number 3, that $52.8 billion debt load means short-term share buybacks are paused, which caps immediate EPS growth. So what is the single biggest thing to watch next? To verify if this massive pro integration is actually working before the macro environment even shifts, investors really need to monitor average transaction ticket size and inventory turns over the coming quarters. If inventory keeps building up and those turns decline further, you'll know the integration is hitting friction.
If you want the full research, including the deeper framework behind this video, you can get it free at flash.stocksentinel.ai.
Ultimately, Home Depot's massive $53 billion bet isn't really about what the housing market is doing today. It's about dominating a newly expanded $1.2 trillion TAM so that when the ice finally breaks, they own the entire ecosystem. Until next time, do your own research, and I'll see you in the next one.
Check out Flash at flash.stocksentinel.ai to access free research and videos like this one for any company in the world.